Hello, everybody. Welcome to today's video. And before we start discussing about various things, let's have a quick wrap up of the Indian market today. Um, the market is pretty much uncertain what it is going to do. In fact, there was not any up move or downward move in the market. We are just standing at what we were having the levels yesterday. But the PSUs have grown by about BSE. PSU index has gone up by 2%. So the government companies and PSUs have certainly gone up today. I don't know whether it is the repercussions of the third phase of elections, and some people in market know better than others. But the ground reality is that the PSUs have gone up. Uh, Now let's come back to one of the important discussions for today. That is uh, the importance of qualitative analysis of a company. We have talked about how can we create the Google Finance model, and how can we do a quick analysis of the various ratios, that is PE ratio, then debt to equity ratio, then ROE, ROC of a company, and looking at the sales growth of the company and how is it performing, what are the business fundamentals of the company, how does it make money, and how does it service the customers. We have talked about those quantitative numbers in our previous videos. If you have not seen, kindly subscribe to the channel and look at the videos that we have posted up beforehand. So qualitative analysis. One of the stories that I'm reminded of is 1.5 years back. The the price of Amazon was at very attractive price. It was very attractive. Just to share the screen with you, that it had gone down up to $83, which was a drastic change, and primarily. So if you see over here, Amazon's price had gone in 2023, at the end of 2022 or 2023, it was going up to $84. So it was, and if you see the curve of Amazon, it has been going up always, but suddenly it had started coming down. And the primary reason for this decrease in the share price was it's not only that Amazon's price was going down, no, price of most of the companies was going down, which was triggered by the increase in the interest rates in US market. All right. So all the tech companies were going down. Amazon was going down. Google was going down, and the main reason was that the businesses didn't have. Let's see why the whole share market or the equities market was going down. So what happens with the interest rates is interest rates is declared by the central bank of any country. In India, it's RBI, and in US, it is Fed. So if the interest rates go up, then the borrowing of the money becomes more expensive. So just like people borrow money, that's the same way that the companies also borrow money. And that's, we have talked about this thing in our previous videos also, that debt is one of the asset classes that the companies has, or one of the modes of raising money. So if debt is expensive, then the companies will not be able to raise money through taking short-term and long-term loans, and they will not be having liquidity of the cash. So that impacts every business. Not every business will not be able to afford 6-7% of interest rate in US, and that's a lot in a country where the interest rates were in the range of 2 to 3% maximum. So suddenly, when the interest rates went up, the liquidity was taken out of the capital markets. So the companies were not borrowing money; they were not taking loans, and if they don't borrow money, then they are short of cash, and they will not be spending money. And that's what Fed wanted, because they wanted to control the inflation because there was overspending in the Corona times. So since the liquidity is not there, the businesses, the small and the medium and the large businesses will not be spending, and they will not be first. Cuts of the budget will be happening in the tech spending of all these businesses, and that's why tech companies were the ones which were most impacted during that time. Amazon had come down up to $83, and Google had followed the same kind of scenario. All right, so at that time, either we keep sitting or we identify whether it is an opportunity or not. So the qualitative analysis of Amazon is that I did at that time, that I am using certain products of Amazon already. All right, I am using AWS. I'm buying from Amazon as a retail customer. I keep ordering from Amazon. So I have not stopped buying from Amazon. I've not stopped using AWS. In fact, I love AWS than its competitor products. So only thing is that I am not spending more into getting more services from let's say AWS or Amazon retail. All right. So that was one of the triggers that I have not stopped buying. Millions of people have not stopped buying, and if you look at the revenue figures of Amazon, the two main streams of revenue are there. One is Amazon retail, and another one is AWS. More than 60% of the revenues come from Amazon retail. But the issue with the Amazon retail is that the margins are very less because it's retail, right? And they are not able to make much money out of it. Even if they are making sales of 100 rupees, then they are not able to make more than $10, $11 for the $100 goods that they are selling. On the contrary, in AWS, the operating profit margins are 60%. So if they are selling $100, then they are saving about $40 out of it. All right. So the reason, if we looked at the scenarios or the sales or reports of that quarter, then I could see that the Amazon retail business was more or less same. It was not coming down, but it was what drastically had come down was AWS business. And since the margins are more in AWS business, so the earnings were coming down for Amazon as well. But there was a clear explanation for this reduction in sales growth and reduction in earnings. The earnings were getting reduced, and there was a clear explanation of that. And it was triggered by interest rate prices. So if the interest rate prices are going to be cut, let's say 1 year, 2 years from now, then the spending will again come back, and it will again come back to the premier product only. And from my usage, I knew that the AWS is much superior product than let's say the other companies. So that was the reason that I identified that this is the right time that I start investing into Amazon, because it's down under, it has been at all-time lows. This is the right time to buy the dip. So this is both a success story and a failure story as well. But since I was relatively new to the investment world, I didn't take a bigger bet on this thing. I should have taken a bigger bet, because the analysis did say that I should have invested more in Amazon at that price level. So I invested, but didn't invest in that much aggressively into Amazon. Similarly, I was using Gmail, I was using other Google business products as a small time business, and I could see that the current prices of Google at that time, at the end of 22 or starting of 2023, it was not justified that it was so low. And it was such a bargain at that time that I invested in Google also. Not as much as I should have invested. And in those times when you identify this opportunity, this was the first time experience that I had when I went and discussed with other people. Everybody was sitting on the fence, and they were not investing in Amazon, and they were like that. They thought the Amazon story or Google story was not coming back to normal, and they will be, the stock price is not going to go back to normal. But my rationale was, if the customers are loving it, they are spending for it, eventually the stock price will catch up. All right. So long story short, I took a bet on it. I bought that dip at that time, and at that the time I bought it was about $90. It still further went down, and once you take a bet on something and it further goes down, then the panic starts happening with you. It's but natural. But my theory was, if it is going down, then it is opportunity to buy more. In fact, I bought more when it went below $90, and I ended up having an average of about $88 on the stock, and currently the stock is as of today, it is at $188. So I'm sitting more than 120% return on Amazon alone, and on Google, I am sitting on a return of about 70-80%, which is a very healthy return if you see the time horizon is just 1.5 to 2 years. And on top of that, what are the more positive upside to this this investment is that the interest rates still have not been cut by Fed. The liquidity still has not come into the primary liquidity has not come into the market yet, where the small and the medium businesses will start expanding and start allocating more budgets to their IT infrastructure. In that scenario, again, we'll be looking at that. The company's earnings will be improving, the results will be improving. If the company's results improve, the sales are more, the earnings are more, the profits are more. Eventually, the stock price is going to go even higher. That's my that is how the qualitative analysis of a company does work, in conjunction with the quantitative analysis, that you look at the quantitative figures and you are doing a qualitative analysis of what is happening and why is something happening. All right. So I hope you enjoyed this session. If you have any questions, or if you have any comments, or if you have any feedback for these videos, or what kind of discussion we should be taking for the investing world, then please do comment on the video and give us your feedback. If you want, the other people should be listening to this kind of fundamental discussions, then please share, subscribe, and like this video. And just a quick disclaimer, this video is not in any sense is going to give you any investment advice. So don't take my investment advice. Don't think that, okay, if I have invested in Amazon or Google, this is an endorsement for that. Just do your own analysis. Talk to your financial advisor. I invested in these two companies at a time when it was at really attractive prices. I don't know whether the current prices are really attractive or not. That is, I leave that to your thoughtfulness and your analysis. Bye. Have fun.